It was a fascinating market last week. Lots of information both here in the UK, also in Europe, and also we had some coordinated central bank action. And it's a clear demonstration of how difficult it is for the bears of this market to maintain positions, because while certainly last week in the early part of the week we were seeing sort of further declines, it's a single action out of the central banks that causes such a big spike in stock markets and makes it, as I say, very difficult for bears to hold on to positions during that market. So a lot of psychology playing out, I suspect, in very much short-term trading. Let's take a look at the chart.
Stronger than expected. 52.1.
We've just had here just a demonstration of how quickly this market rallied from what was looking like a deteriorating position and rallied back up to the top end of the range, the recent trading range. And this puts the FTSE still down about 5% on the year. The FTSE 250 is down about 10%, so the more domestically focused UK position is worse at the moment. But into any rally, I suspect the FTSE 250 will be the outperformer at the moment. But we need possibly another 300 points on the FTSE between now and Christmas to reclaim a sort of break-even position on the course of the year, and not beyond the realms of possibility, particularly given what is going on in Europe at the moment. So let's really just summarise just what we had last week. It started off pretty poorly. We had yields in Europe starting to break higher in Italy, Spain, and also in Germany as well. We saw a crossover in German yields. This chart here shows four of the sort of key components of the European yields. Let's take a look at Italy here, the top line. This is Spain. We come into France and Germany here, but you can see the sort of rising yields that were taking place earlier this week, causing some real concerns as people started to extrapolate some of those yields out and the impact on the economies, and really coming to the conclusion this is unsustainable. But we in the middle part of the week we heard on a surprise decision some coordinated work that was taking place with the Fed and also some of the European central banks. The UK bank was involved, Japanese central bank was involved, in terms of reducing or increasing the liquidity available for dollars. And this really, as I suspect, the read across from this was a big drive up in equity prices, on reflection of the fact that it looks like central banks were getting the message, and that there were some real stresses building into the system here, and they needed to act quite quickly. So we saw what we refer to as a risk-on trade, equities rising, and some of the yields here in European debt beginning to fall. This week, Europe remains very much centre stage. The European summit is taking place this week, and the press over the weekend was full of information about a coordinated approach coming from Europe. My suspicion is that the detail is a lot more divided than the press releases that are coming out. Clearly on one side we have Germany very much sticking towards the austerity formula and looking for fiscal union within Europe, and the French at the moment, how much national sovereignty are they going to give up under this new world? So my suspicion is that we'll see lots of headlines, but the detail will take weeks and weeks to work its way through. But for the moment, we go with it. Yields are beginning to fall across the market, and that is allowing some resurgence of interest into equities. And I think this is further supported if I look here at the US, that behind the scenes, the US has actually been putting together quite a strong list of good data. It's coming in the form of unemployment coming in lower than expected at around 8.5%, but we're also seeing some of those forward-looking indicators. I mentioned last week about the issue of consumer confidence around Thanksgiving. Those numbers were all well ahead of expectations, and so the US has now put together, as I say, a string of data that is actually indicating that next year's forecast for growth of the US of around 2.5% is looking on firmer footing at the moment. Unfortunately, as I say, the UK is in a tougher position, and that was revealed in the autumn statement. Lots of gloominess about what's required there, and I think it's pertinent to point out that the debt in the UK will continue to rise very significantly under this current Parliament, and that's with a government that understands the position of debt and is doing its best to get it down. So it indicates that the UK at the moment really has to get to grips with its debt position, which is at the moment not in a comfortable position. Thankfully, our yields on debt still remain under some control, so that's helpful. In terms of this action that we saw last week, it is worth reflecting that the immediate beneficiaries into any stimulus is commodities. Here I'm just pointing out WTI. This is the oil chart. Oil is beginning to rise again. It never really came off far, as you can see, during the financial crisis. World trends, they're continuing to dictate the growth in oil. So I continue to think that whilst it's not headline stuff at the moment, oil needs keeping close attention. And also copper. Let's take a look at the copper chart. Here, which we saw quite a big spike in copper on the back of that particular move. So attention this week, as I say, be very much on the Euro summit, be very much on the headlines that come out. Expect a more coordinated response from Europe at the moment to try and get on top of its particular problems. But as I say, in the backdrop, keep an eye on the US economy, because I think that economy is on the turn and could well be a saviour for equities from maybe a year-end rally. Could we get back to a break-even position is the big question.